The first thing that breaks in a financial system is not the stock market. It's not banks collapsing. It's not even money.
It's trust. And by the time you see prices crashing on a screen, that trust has already been gone for a while.
That's uncomfortable because we like to believe financial systems fail loudly, with alarms, with headlines, with obvious warning signs.
In reality, they fail quietly, in rooms you never see, in decisions that sound reasonable at the time.
And right now, this matters more than most people realize.
We live in a world that runs on promises. Your salary, your savings, your pension, your bank balance.
None of those are physical things. They are agreements. Agreements that say this number will still mean something tomorrow. So let's walk through what actually breaks first.
Not dramatically, but mechanically. Start with a normal day. Banks lend, businesses borrow.
People swipe cards. Money flows smoothly. Underneath that flow is a simple assumption. Everyone involved believes everyone else will honor their obligations.
Banks believe borrowers will repay. Businesses believe banks will stay open. Markets believe prices will be there tomorrow.
This belief is so basic that we stop noticing it, until it starts to crack. The first break is not default, it's hesitation.
A bank starts asking slightly tougher questions. A lender delays approval. A market maker widens spreads just a little.
Nothing scary, nothing illegal, just caution.
This is where most people miss the failure. Because on the surface, everything still works.
ATMs function, cards swipe, markets trade.
But the system is already changing behavior.
Here's the hidden mechanism. Modern finance is built on leverage. That means using borrowed money to amplify activity.
A lot of activity. Banks don't just lend money they have. They lend based on confidence that funding will always be available.
Markets don't just price assets based on value, they price them based on liquidity, the assumption that someone else will always buy.
When confidence weakens, leverage becomes dangerous, and the first thing to break is liquidity.
Liquidity sounds technical.
It's not. Liquidity simply means, can you turn something into cash quickly without losing much value?
In a healthy system, the answer is yes. In a failing one, that answer becomes maybe, then no.
This is where irony shows up. Assets don't suddenly become worthless. They become unsellable.
A bond might still promise full repayment. A mortgage might still be backed by a house. A company might still be profitable.
But if no one wants to be the buyer today, the price collapses. Not because reality changed, but because confidence did.
This is why markets freeze before they crash.
And here's the uncomfortable math. Most financial institutions operate with very thin margins of safety, single-digit percentages. That works only if assets can always be sold when needed.
Once liquidity dries up, losses accelerate. Not slowly, suddenly. Now comes the second break. Interbank trust.
Banks don't operate alone. They lend to each other constantly.
Short-term, overnight, sometimes for just a few hours.
This system assumes banks trust other banks' balance sheets.
When that trust weakens, banks stop lending to each other. Not because they're insolvent, but because they're unsure.
And uncertainty is enough. At this point, central banks usually step in. They provide emergency liquidity. They lower rates. They make reassuring statements.
Sometimes it works. Sometimes it doesn't. Because the real problem isn't cash, it's belief.
Belief that tomorrow's promises are safe. This is where the public finally notices. Credit tightens, loans slow, hiring freezes. Prices start behaving strangely.
Not just falling, but swinging. Volatility rises because no one agrees on what things are worth anymore.
And this is where the myth collapses. We're told financial crises are caused by greed, or bad actors, or reckless speculation.
Those things exist, but they're not what breaks the system.
What breaks the system is synchronization, everyone pulling back at once. No conspiracy, no coordination, just shared fear.
The moment institutions stop believing they can exit positions safely, they stop entering them at all.
Trade slows, investment stalls, money stops circulating.
And here's the cruel twist. The system that depends on confidence is also the system that destroys confidence fastest.
Losses force selling. Selling lowers prices. Lower prices create more losses.
A loop. By the time governments announce bailouts or reforms, the damage is already done. Because trust doesn't respond to press conferences. It responds to behavior.
And behavior has already changed.
Zoom out now. This is why financial systems don't collapse evenly. Some people feel nothing, others lose everything.
Access matters. Timing matters. Information matters.
Those closest to liquidity survive. Those dependent on credit suffer first.
And here's the final uncomfortable thought. The system doesn't fail when money runs out. It fails when belief does.
When enough participants decide that waiting is safer than acting, that lending is riskier than hoarding, that tomorrow is less predictable than yesterday.
So when the next crisis comes, and it always does, the question won't be what asset failed, what bank collapsed, what policy was wrong. The real question is quieter.
Who stopped trusting first? And how long before everyone else followed?